Funny Shekhar Jones, as fund manager with Angel Stockbroking. Funny, for the quarter gone by, Indian markets were down by about 3.5%, a little over 3.5%. What's in store for us for this quarter?
Well, it will broadly depend on what kind of global news that you get. But more importantly, as we move towards the later part of the quarter, I think the market will start keenly anticipating a good monsoon, because more than a monetary policy in May, or what happens on the political front, unless and until the government is toppled, of course. So barring the routine political noises, I think expectation of a good monsoon is going to be the next big catalyst for the market, because by now there is a growing realization that irrespective of how much rates go down from here on, and realistically they may not go down by more than 50 basis points, and whatever new policy pronouncements the government might make, which will not have an impact for at least the next 3 quarters, the immediate catalyst can be a good monsoon, especially on the back of a poor monsoon last year, so that your agricultural growth and the entire rural growth consumption story can be taken care of, because that to a large extent is still isolated, just like we saw in 2008-9, is still isolated from the shenanigans of government policy.
Funny, hi, morning. Soon we'll also be looking at earnings trickle in. Do you think it's all in the price already, or could there still be some positive or negative surprises?
Well, 2013 mostly had been written off by December. So while the market started going up from September, it was more on the back of what could happen starting 2014, that is financial year 2013-14. So this year we will end up with around 8 to 9% earnings growth, and we should feel lucky, because last quarter we did hardly 4%. That's for the index. Next year, that is FY 13-14, although we are not seeing any immediate signs of revival in the economy, purely mathematically, because oil and gas, which has around 15% weight in the index, seems to be in a better shape than last year. Then you have IT and pharma, which cumulatively have about 25% weight in the index, are structurally in a better shape this year. And the slowdown in FMCG auto is not as sharp as the contributing slowdowns in metal infrastructure last year. And metals, which already experienced a sharp slowdown last year, is not going to slow down that much more. Mathematically, you are looking at 12 to 14% earnings growth, which should mean that everything else remaining constant, which is a big if, we should be holding these valuations of around 13 times. So to that extent, we have been advising investors to invest in good quality sectors like private sector banks, or defensives like utilities, like stocks like NTPC or Power Grid, which have regulated returns of 14% and which have very sharply corrected. We are advising investors to take advantage of these declines.
Funny, you've got a new listing as well today, Repco. While it is engaged in the business of housing finance, do you think it's a good environment, or good timing rather, for such an issue to hit the markets?
Well, I have not gone through the valuations of the issue in detail, so can't really comment specific on the issue. But housing NBFC as a sector certainly seems attractive, especially those entities which are engaged in low-cost housing. So within that space, GIC Housing Finance followed by LIC Housing Finance are our top picks.
Funny, what are your thoughts on global cyclicals now? Hindalco, Sterlite, Nalco, do you think the risk-reward ratio in the near term is looking slightly favorable, because most of the global cyclicals are beaten black and blue?
Very difficult to say, because if you, for example, look at aluminium prices, they have broken down from levels of $2,100. Because a couple of years back, $2,100 was regarded as sacrosanct, below which mining was supposed to be unviable. So they have broken down from multi-year range. More importantly, if you look at global markets, there is a equity rally that's going on. So, considering the evidence of the last 8 years, you have a risk-on rally across all risk asset classes. So traditional economics, while it will tell you that equities and commodities should have an inverse relationship, but evidence of last 8 years is that they would have a positive correlation. But even in this kind of an environment, with around 3 bouts of liquidity from the US Fed and around 3 bouts from European Union, if commodities are finding it difficult to find their feet, then I guess one should be skeptical about their at least medium-term outlook.
Funny, how is the market likely to react to the current account deficit numbers? And do you think that could perhaps bring some bit of a speed breaker right now?
That is something that was known, so it's not coming as a news. So I think a major part of the reaction was already seen over the last 6 months when it was known that this is the run rate that we are going to hit. What's important is the market would look forward to what has been the efficacy of the steps that the government has taken so far, the evidence of which is not much, barring some aberration that we saw in February where imports grew slower than exports, but one needs to see whether that's an aberration or a trend. If that's a trend, then I think market would take heart from it. Other than that, I don't see any special stress on the rupee, so you might look at a currency that is around the 54 levels. But yes, flows will be very keenly watched in this kind of market.
What is the deal with Reliance? It's just been a one-way ride for Reliance on the downside. It's down for 9 days on the trot now. In quick time, Reliance Industries, which is India's biggest private sector company, has retreated from levels of 875 to sub 775.
Well, it's a bit intriguing because one would have hoped that the biggest pain in that business from the natural gas come 2014 would be addressed to a large extent because of the prospect of renegotiation of price upwards. But that's something that the market is discounting at this point in time, and for reasons understandable that it would take the next government to renegotiate that. But considering the cash flow profile of the company and the relatively attractive valuations, I would tend to veer on the side of buying Reliance Industries at this point in time, because one must remember that this is a market which, as the year progresses, is going to reward the defensive kind of businesses.
Funny, but if there is one group where incremental news flow has improved, is the entire energy space. Be it a diesel price hike in place, followed by some key assumptions that gas price hike will be in place. So the core fundamentals for the oil and gas space or sector, they have improved. But if I map how energy stocks or oil and gas stocks have moved this year, they pretty much have come crashing down. Reliance, Kain India, HPCL, with the exception of ONGC, nothing is moving there.
That's right, and that's got a lot to do with the whole dynamics of this sector, because ONGC would have been the biggest beneficiary of any reduction in subsidies. But what is more important is it has been even our assessment that at least for the next 6 months, the energy space might be an outperformer. But considering the latest political volatility, we have been forced to revisit that assessment. And now we believe that over the next 3 months, maybe tactically energy will offer you good buying opportunities, at least on every decline. Because come around December, that is 6 months from the scheduled date of elections, you can be very much sure that governance will take a back seat and politics will take the front seat. What it means is you can very well have a situation where the regular diesel price hikes may not happen every 30 days. So these are all possibilities that are open. So considering all that and the amount of dependence that all these valuations have on fuel price revision, we would tend to assume that around 3 to 4 months down the line, if political activity increases, then that's the time that you must look at exiting this sector, at least from a tactical perspective.
Funny, less than a fortnight and we would be analyzing Infi's earnings as well. Do you think IT earnings are likely to be better than others in the fourth quarter this time, and is that a given and already in the price?
That's a given, that's already in the price, but because of any lack of any other viable alternatives in sectors, I would tend to believe that this sector might get re-rated further. So investors would have a bias towards overlooking any negatives in the sector, and they would tend to magnify the positives. So to that extent, I would think that even if Infi were to deliver on analyst expectations, and there might be a further PE re-rating, because it's still, even today, TCS is trading at around 20-21 times, whereas Infosys is trading at around 15 to 16 times on a lower growth forecast. So there is that much more headroom for Infosys relative to TCS, but my hunch is both will go up.
At the current juncture, how exactly would you approach a stock like Asian Paints? The growth is predictable, the company is growing, the stock is up 50% plus in last 1 year, but the problem here is that it is very expensive.
As a retail investor in search of absolute returns, this is a stock, and generally the FMCG space can be clearly avoided. However, this stock may not correct in line with the market because there is a large number of institutional investors who have to compulsorily invest in the market, and to that extent, they would like to stick with these kind of companies. As you correctly pointed out, the business cycle is almost at its peak. It has been doing well for the last 4 years. And it is never a good time really to, irrespective of what the valuations are, to buy a company at the peak of its business cycle. Because as that peak reverses, you will both have sharp declines in earnings as well as in valuations, which can lead to humongous amount of wealth destruction. But for the time being, although there is some kind of slowdown, which even the company had indicated, because of the very uncertainty in the rest of the sectors, investors might still hold on to this stock.
Funny, let's discuss the macros for Indian markets. When we started the year, the assumption was that the GDP growth will pick up, inflation will top out, and current account deficit will also bottom out. But if I look at how macros have moved, at least for the quarter gone by, things have got from bad to worse.
Well, we were clearly very optimistic, that is the entire market, and so was the government about how the macros will pan out. But I guess the market now has a more realistic expectations that macro should not get any worse from this point. So you should not see GDP growth below 4.5%, and everything there will depend on how inflation and the current account data are moving. So at this point in time, I don't think the market is pinning any great expectations on what's likely to happen. So while WPI has clearly moderated, the CPI is not expected to moderate anytime soon, especially with things like the food security bill coming up. So I guess the market has kept its fingers crossed, and that is actually shown in the kind of performance that you are seeing across sectors. So you have high beta names in the infrastructure investment cycle which have consistently outperformed from the last 2 years, and they have just been beaten down more in this year, while defensives and high quality names with strong cash flow profiles have done well, and that's a trend that I guess will continue over the next 3 to 4 quarters.
Funny, if quality was the theme for FY13, do you think industrials could be the theme for FY14?
Very likely, very unlikely, because industrials will not do well so long as the economy is registering this kind of tepid growth. So I guess industrials will still have to wait. Although valuations are looking attractive, but stocks seldom go up merely on the back of valuations. They have to be supported first by earnings growth. So I guess industrials more or less as a basket can be looked at only in the run-up to the next government formation.
Funny, Bank of America Merrill Lynch today has come out with a report on Reliance Infra, and Bank of America Merrill Lynch is making a case that Reliance Infra is a beaten down quality stock. They've got cash in their balance sheet. The order book is also strong, and if they're able to execute 2 or 3 projects in next 12 months, the stock could get re-rated. So do you think in the near term it makes sense to buy some of these beaten down quality construction names?
Well, again, depends on your horizon and risk-taking capacity. I agree with all the points on Reliance Infrastructure, but one needs to remember that because they had a large amount of cash on the balance sheet and they wanted to ramp up the business very quickly, they got into many contracts that were suboptimal, the result of which you are seeing on the stock price at this point in time. So with the ROE profile of 5 to 6%, although the stock is trading at a book value of below 0.5, with reasonably strong investment in Reliance Power, I guess till you see cash coming into the balance sheet, cash coming into the income statement and balance sheet through the monetization of all the BOT projects that they have over the next 18 months, you are very unlikely to see any sustainable valuation re-rating and to that extent stock price.
So Funny, just going by the index levels per se, tactically would this be a buying point for you?
It is, because this year is more or less likely to be like what it was for FY13, in the sense that you will still have, I guess, private sector banks, if bought on 5 to 10% declines from here, which might still give you around 15 to 16% returns. That's the worst case scenario, because credit growth of that extent is happening, and since they are gaining market share, they'll still give you those returns, and asset quality is not as toxic. IT and pharma will still do well. As long as you can avoid the high beta names, I think you should be doing well for yourself.